Good morning and welcome to Contract Wednesday. Today we are covering Form 22C, and this is the form where you are agreeing to payment terms with the seller. So you'd use this form when the seller is carrying paper, is what we call it, or carrying the contract, and you want to communicate what the terms of that contract are going to be. So you're not going to use this very often, but it's a critical piece when dealing with a buyer and seller who plan to have the seller carry the contract. So we're going to cover this in great detail and lock it away on a video so that should the need arise, you can refer back to it. And let's get started. Boom. All right. So Form 22C, you can see up here it has not been revised for over 2 years. And that's because they did a good job of writing it initially, and it's pretty straightforward, actually. So this is an amendment or an addendum to the purchase and sale. So that's why it references the purchase and sale agreement dated XYZ date between buyer and seller regarding the property address XYZ. So general terms. Buyer represents that the property will or will not, and defaults to will, be used as a residential dwelling. If the property will be used for a residential dwelling, this addendum may only be used if seller is a natural person and not a loan originator, estate, or trust. Sorry, not a loan originator, but can be an estate or trust. Seller has not financed the sale of another property within the last 12 months. Seller did not construct or act as a contractor for the construction of a residence on the property in the ordinary course of seller's business. The repayment schedule does not result in negative amortization. The financing has a fixed rate of interest or an adjustable rate of interest that is adjustable after 5 or more years, subject to reasonable annual and lifetime limitations on interest rate increases, and seller obtains a waiver from the Washington State Department of Financial Institutions under RCW 31.04.025 subsection 3. Man, why do you think they have all that in there? I can tell you why. This is all born of the Great Recession and the revision to the financial markets of Dodd-Frank. You guys all remember Dodd-Frank? Well, Dodd-Frank says that lenders at large, mortgage companies, can't do negative amortization, can't have an adjustable rate mortgage that adjusts more quickly than 5 years or longer, can't do this, can't do that, can't do this. So these requirements are a direct result of the Dodd-Frank legislation, and they're basically making sure that, hey, just because you're a seller and you intend to carry paper for this buyer, you're still bound by these same rules. You can't do negative amortization. You can't do prepayment penalties and all this other stuff. So that's right there front and center to make sure that the person carrying the paper complies with the terms that are required of the rules and the laws, and also that they are not in a position to exploit consumers. Because loan originators, builders, and contractors could take advantage of people because of their savviness in the industry. So they just prohibit it outright. All right? Paragraph 1B, limited practice board forms. The current version of any limited practice board form referenced below shall be attached to this agreement as a blank form. We'll get into what they're referring to in the latter parts, but they're basically talking about deeds of trust and other types of security instruments. And so they're warning the people that sign this, hey, you're agreeing to use certain forms, make sure they're attached so you can review those too. Paragraph 1C, attorney review. Buyer and seller are advised to seek the counsel of an attorney to review the terms of this agreement, and this agreement is conditioned upon review and approval by counsel for buyer and seller unless a party gives written notice of disapproval of this agreement within blank days of mutual acceptance. This contingency shall be deemed satisfied. So it by default gives both buyer and seller the chance to go get it looked at by an attorney. It doesn't force them to. It advises them to, but it also will expire if they don't take advantage of it. If you have a seller that's thinking about carrying paper, they should consult an attorney. If you have a buyer that's looking to enter into an agreement where the seller carries the paper, they probably should as well. Paragraph 1D, attorney review of non-standard provisions. If buyer and seller agree to financing terms that differ from the terms in this addendum or an attached LPB form, including but not limited to making interlineations or otherwise modifying or supplementing any pre-printed terms in this agreement or attachments thereto, the party shall have this agreement reviewed by legal counsel. If buyer and seller do not give notice of approval of this agreement by their counsel within blank days of mutual acceptance, this agreement shall terminate and the earnest money shall be refunded to the buyer. So in paragraph 1C, it's, hey, have an attorney look at it, and if you don't raise your hand and disapprove, it'll expire. But in paragraph D, because D is only triggered if you modify this templated form, they make it even heavier handed. They say you need to go get it looked at by an attorney, and if you don't give us notice that everything's okay, then the deal's dead. So that's the opposite expiration. So it's very important that you understand that. Paragraph 1E, prior indebtedness and security. Seller understands that seller's security interest in the property may be inferior to a third party's interest in the property, such as a prior lender. So if I'm selling my house to Doris on a contract, that interest that I'm selling is inferior to my mortgage lien holder because they're in first position. So they could foreclose and Doris could get screwed, is what that sentence is telling us, right? Paragraph 2, down payment and interest rate. So now we're starting to get into the actual terms. Remember, this form is called payment terms. Buyer shall pay a down payment, including earnest money, at closing of blank dollars. So in our example, we'll just keep going with Doris's purchase of my home, and let's say I'm selling it to her for $500,000, and I want her to put 20% down. That's what I would put there. Could I put 5 or 10%? Sure. But as a seller, I want her to have skin in the game, so she's more likely to make payments to me, right? This analysis, this evaluation is just like your lender makes of you. You know, does Donald have enough down payment in his home to be incentivized to make the payments? And if he doesn't, then they'd ask for a bigger down. All right. Down payment will be applied to the purchase price. The balance of the purchase price, the indebtedness, shall accrue interest at blank % per annum. What's today's market interest rate? 3.5 to 3 3/4. If I represent the seller, I want that number as high as I can negotiate. If I represent the buyer, I want it as low as I can negotiate. It is to be negotiated. If you guys can't agree, then go, what if we just use the prevailing 30-year fixed rate? And most people will agree to that. If they can't sweeten the deal for themselves, they'll at least agree to what's normal. What's normal right now is pretty awesome, right? Interest will begin to accrue on. How do you think the lenders do it? The day you close.
On closing.
Yeah, because that's when the money was forwarded, advanced, lent. They wired it to escrow. They're going to start collecting rent on that money immediately. Now, could you negotiate, to sweeten the deal? Maybe the seller's having a hard time getting it sold, and they'd say, hey, Doris, if you buy this house, we'll give you the rest of the year interest-free, right? You see that for furniture and other types of deals. You could do that here, right? In which case, I would say interest to begin accruing January 1st, 2017, in my example. But most commonly, it's going to be upon closing. Paragraph 3, payments to the seller. Payments to the seller shall be, there could be a scenario where there are none, right? Hey, I'm going to do this. I'm going to buy it. I'm going to put a big chunk of money down, but I'm not making you any payments because I got to do a bunch of work on the house. It's a dump. Okay, well, no payments for 2 years and then you pay me off. I'd agree to that. Something like that. Principal and interest payments. So you'd actually have to do an amortization calculation or interest only. All right? The installment payments, if any, shall begin on, now here's what's most common, the first day of, not the next first of the month that's coming, but the one after. All right? So let's say Doris, in my example, bought my house today on a contract. Her first mortgage payment to me is going to be on November 1st. This is how the lenders do it, because every mortgage payment is 30 days worth of interest. Well, if she gave me 30 days worth of interest on October 1st, she will have overpaid because she didn't buy it until the middle of the month. Make sense? Then shall continue on the first day of each succeeding month, right? Until the debt's paid off. Could you make it come due sooner than that? Absolutely. And we're going to get into the term, right? We've talked about the interest rate. We've talked about the payment schedule. We haven't talked about the length or term. So paragraph A, 3A, is the payments. 3B is the security interest. So are we going to use a promissory note and deed of trust? Or might we use a real estate contract instead? Or maybe assume the mortgage that's already against the house that the seller has. So you have to decide that. Now, what's most common is this one, promissory note and deed of trust. And this is where you get into the LPB forms, because you're going to want to use forms to specify the promissory note and specify the deed of trust. All right. Security. The indebtedness shall be evidenced by a promissory note and a blank deed of trust. Now, in my example, I have a mortgage. I'm selling it to Doris. So yours is going to be a second deed of trust, your security interest, because my mortgage is in first. If my house were free and clear, then I could give it a first deed of trust. It's just chronological. If I have a first and a second, then she's in a third position. Make sense? So in our example, we're going to say second deed of trust, because that raises some other issues, and we want to make sure you're aware of those issues. All right? B2, promissory note. Buyer agrees to sign at closing the board form 28A, which is a promissory note. We'll cover that in a separate video. B3, deed of trust. Buyer agrees to sign at closing the following selected form. There's only two of them, and the difference is one has a due on sale clause. So in my example, I'm selling my house to Doris. Let's say my mortgage company is Bank of America. If they knew I was selling it, they would call my mortgage due, because all conventional loans have a due on sale clause. The reason is B of A underwrote Ed Lane and my income and my credit and everything else and agreed to lend me money. They have no idea who Doris is, so they don't know whether they would make her that loan, so they would never agree to it. That's why you don't see assumptions happen very often anymore. So the most common deed of trust you're going to use is probably the due on sale clause one. You should try and negotiate it if you represent the buyer, so that there is no due on sale clause, because then that would give her the flexibility to resell it again. Make sense? All right. Paragraph B4, due date. The balance of principal and accrued interest shall be due and payable in full on, what do we want to say? Well, what's most common is people use these because they can't qualify for a mortgage. Otherwise, they wouldn't do this, because they know the pool of houses that they have a chance to buy shrinks when they can only buy from sellers who are willing to carry the note. So what's really common in this practice is you use this, but you give the seller assurances that, hey, this is only temporary. My client is going to refinance this whole thing and get you paid off in full as soon as humanly possible. Now, most people's issues, credit issues, income problems, etc., can be solved within a couple of years. So a very smart practice is to recognize that you need 2 years and then pad it, because once the issue is 2 years old, let's say I had a bankruptcy and I can't get a new mortgage for 2 years. Well, I can't even start to get the mortgage until it's 2 years seasoned. So really what I want to do with this paperwork is make it good for 3 years so that I have time to qualify for and close on that new loan. So in our example, her first payment was November of 2016. We're going to say November 2019. Right? 17, 18, 19. Yeah, so that's 3 years out. So what Doris would do in this example is make her payments on time, do a great job, and then apply for a new mortgage in the beginning of 2019 so that she could close long before November rolled around. Plus, then if she ran into any difficulty, she could shop different lenders and scramble and find a solution. Failing that, she'd have to approach me and say, I need more time. And then we would just negotiate an extension. At that point, we might revise the interest rate because rates have moved or do something. But if she can't get me paid off, I probably should cooperate with her to help her get in a position to pay me off so I can get my money out, right? Default and default interest. During any period of buyer's default, the principal shall bear interest at a rate of, look at the default is 18%. Again, these are all to be negotiated. So if you represent the buyer, try and get it lower. If you represent the seller, stick with this number because anything higher would be illegal. All right? A late charge of blank dollars or blank percent of any installment payment, 5% is what's customary in mortgage lending. So that's why this defaults to that. That's what you could use and look somebody in the eye and say, this is typical. They might say, gosh, that seems onerous. How about $150 or something like that? Again, all to be negotiated. So 5% of any installment payment shall be added to any payment more than blank days late. Right? Again, that's customary. Mortgages, conventional mortgages, the promissory note says due on the 1st, late on the 15th. If buyer has not cured any default within 30 days after written notice, seller may declare all outstanding sums immediately due and payable. That written notice is a notice of default. That's why notices of defaults happen on one day, and a notice of trustee sale doesn't start for 30 days till 30 days later. Make sense? Because remember, as the seller in this scenario, you're acting as the lender. So all of these provisions and protections treat you as a lender. All right, paragraph 6. Prepayment. Buyer may prepay all or part of the balance owed under this agreement at any time without penalty. Dodd-Frank, prepays are illegal. So this explicitly doesn't allow them. It prohibits them. Paragraph 7. No further encumbrances. Buyer shall not further encumber the property until seller has released seller's security interest in the property. So in our example, Doris is buying my house. Her interest is in second position. She couldn't go out and go get a line of credit from BECU or something and have it go behind her in third position. BECU would never do it. It's also not allowed under this agreement. As an express condition of beneficiary making the loan secured by this deed of trust, grantor shall not further encumber, pledge, mortgage, hypothecate, place any lien, charge, or claim upon, or otherwise give as security the property or any interest therein, nor cause or allow by operation of law the encumbrance of the trust estate or any interest therein without the written consent of the beneficiary, even though such encumbrance may be junior to the encumbrance created by the deed of trust. That is $1,200 an hour language that just restates this without any room for misunderstanding. Right? Because I'm the beneficiary in this example. Doris is the grantor. She's basically going into any potential scenario that would encumber the property. Right? Encumbrance of the property contrary to the provisions of this provision shall constitute a default, and beneficiary may, at beneficiary's option, declare the entire balance of principal and interest immediately due and payable. So I can accelerate the note if she breaches this agreement, this portion of the agreement. Does that make sense? Because she's agreeing to not further encumber it, but that doesn't necessarily prevent her 18 months from now, without my knowledge, walking into a credit union, right? But if I find out about it, I can accelerate everything. So that's my hammer. All right. Paragraph C is if we go the real estate contract route rather than the promissory note and deed route. So remember, you may check paragraph B or C, but not both. These are different alternatives. All right. Real estate contract. Note, if the property is primarily for agricultural purposes, then a non-judicial foreclosure/forfeiture remedy is available only by using a real estate contract. So that's why they put this in here. The stronger, more secure approach is the promissory note and deed. But if it's agricultural land, you can't foreclose on it if you use that approach. So they're recommending you use the real estate contract approach. And I do too. So let me say that again because I just want to make sure it's crystal clear. When you're faced with this, you have to look at the property type and determine, is it a residence or is it agricultural land? Like Linda, you had one recently that was a farm. It had a house, but it came with farmland. You'd want to, if that deal was going to be negotiated with the seller carrying the paper, you'd want to use the real estate contract. In my example, where I'm selling my private residence to Doris, promissory note and deed. Is that clear to everybody? All right. So C1, real estate contract. The parties agree to sign LPB Form 44, which is the real estate contract. The parties agree to initial and make applicable the following optional provisions in LPB form if the corresponding box is checked. Substitution and security on personal property. So we're changing the scenario. I'm not selling my house anymore to Doris. I'm selling my farm to Linda. And Linda says, I want to be a farmer. I want to buy your place, but I also want to buy your John Deere and your equipment and your this and your that. And I go, no problem. I'll sell you everything. Turnkey. It's yours. Well, now I've mixed real property, which is the land, with personal property, which is the equipment. So I'm going to go ahead and let this contract wrap both, because if she doesn't pay me, I want to be able to foreclose on both and take everything back, right? Alterations, that would be if you're going to alter the agreement and customize it and potentially alter the land. In fact, you guys were going to, in your scenario, Linda, they were going to build like an entertainment thing, right? So that would be an alteration. You're changing the use of the land. Due on sale, just like with the provision above, we're saying, okay, I'm agreeing to be Linda's lender in this example, but I don't want her to sell it to somebody else and offer to be their lender, right? Because I didn't know them and I'm not willing to lend them money. I like Linda and I'm going to lend her money. That's it. So if she sells it, then I can accelerate the term of the contract. Prepayment penalties on prior encumbrances. This isn't me putting a prepayment penalty on Linda. This is if my current mortgage has a prepayment penalty, then this loan has to recognize that, this contract, because that would prohibit her from prepaying it. And remember, this is probably getting a little muddy, but prepays are illegal. So I couldn't charge her a prepayment penalty. You guys all know what a prepayment penalty is? Before the Great Recession, lenders would make loans and they would prevent the borrower from paying it off early. And the way they prevented it was by placing a prepayment penalty in there. So what that said was, you're not giving me extra money unless you try and pay me off early. And if you pay me off early, I'm going to hit you with an extra $10,000 penalty. And that's because when I lent that money out at 9%, I want it to stay out as long as possible, because that's a great interest rate for me. Might be terrible for you, Bo, but that's why in this scenario, prepays are now illegal, so I can't put a new prepayment penalty in place, but I might have a mortgage that's been around for 10 years when it wasn't illegal. So we have to have a way to recognize that that's a possibility, all right? Periodic payments on taxes and insurance. In a normal mortgage scenario, you're paying a little bit towards your taxes and insurance every month. Well, in a real estate contract, that's not happening. So we have to understand that we're going to pay $1,800 or whatever the amount is twice a year, or whatever frequency we agree to. All right? Cash out. The entire balance of principal and interest shall be due and payable in full, not later than whatever we agreed to. 3 years. It could be 30 years, right? There's nothing that says it has to be short. But when we represent buyers that want to try and put these deals together, it would be wise of us to recognize that the seller's not going to be stoked to carry paper for 30 years, right? So the shorter we can make it, the better. But sometimes, like Linda might say, well, I have to have 10 years because I'm selling a piece of property in China and I'm going to get a big chunk of money, but I can't sell that for 9 years. So I need you to carry the note for 10. Well, it is what it is. Then the seller just has to decide, is that a deal that they would agree to? They might say, yeah, I'll agree to that, but I want you to pay a little bit higher interest rate or something, right? It's a negotiation. Paragraph 4, assumed underlying obligations and method of payment. So this ties back into the Doris example where I'm selling her my house and I have a mortgage. But the difference here is that Doris is going to assume my mortgage, right? The truth is, I can't tell you of a single lender that would approve a formal assumption. Formal means we put Doris in touch with Bank of America. Bank of America underwrites her income and says, okay, yeah, you can take over Ed's loan. They just don't do that anymore. So what happens more often is she assumes the mortgage and makes the payment on the existing mortgage. So that's what these terms would align themselves with, all right? So consent of holder of underlying obligation. If there's an existing deed of trust, real estate contract, or other encumbrance which is to remain unpaid after closing, and its terms require the holder's consent to this sale, buyer agrees to promptly apply for such consent upon mutual acceptance of this agreement. This agreement is subject to the written consent of the holder of the underlying obligation within whatever days of mutual acceptance. If the holder's written consent to this agreement is not obtained by such date, the agreement terminates. So this language is if we intend to do a formal assumption. Like I said, not likely, didn't happen. Most lien holders wouldn't allow it. So what happens more often is I might still have a mortgage. I'm just going to make sure that Doris's payment is greater than my payment so that her payment covers my payment. And that's what's called a wrap, right? Payment from buyer to seller. Seller will pay the monthly payments of $2,500 due on an existing loan by Bank of America, having an approximate present principal balance of, I'm making all this up, with interest at, right, per annum computed on the unpaid principal and security by the property. Such balance remains the obligation of the seller, and seller agrees to pay such obligation in accordance with its terms and conditions. Buyer shall have the right to remedy any default on the underlying obligation, provided buyer is not in default to seller, and all sums so paid shall be credited to buyer's payments to seller. So that last sentence means if I fall behind on my mortgage, as long as Doris is current with her payments to me, she can go and cure my delinquency. And any money that she spends to do that goes against what she owes me, pays down her balance. The reason she would do that is if I fail to get caught up and B of A forecloses, she's out. She gets screwed. So it's a defensive investment, but it's smart. If she finds out that I'm falling behind, she'd be very wise because she's put $100,000 down. She don't want to lose that, right? She also now has equity in this property. She's going to lose that as well. Does that make sense to everybody? All right. Cash down to existing loan. Buyer agrees to assume at closing an existing deed of trust, mortgage, real estate contract securing the property and to pay the balance of the purchase price in cash, including earnest money at closing. So that scenario is Doris is buying it, and let's say my mortgage is only $150,000. So instead of putting 100 down, she's going to put 150 down, and I have to use it to pay off the mortgage. That way, she's never worried about me falling delinquent, right? And that's a very common structure when you're dealing with older people who have paid their mortgage down quite low and they're getting ready to sell and they want to retire. You pay off their mortgage, keep making payments to them. It's an income stream for them and they're stoked. Okay? The assumed loan is or is not an adjustable rate mortgage. The monthly payments could increase or decrease if the assumed loan is an ARM. So that's just a disclosure. Paragraph 2, loan amount and payments. The assumed loan has a principal balance of approximately, we decided 150, and is payable in monthly installments of approximately, including principal and interest at, computed on the declining principal balance and including real estate taxes and insurance. Seller shall pay any delinquencies at closing, right? This stuff is easy to fill out because you now have a specific client in front of you. You're saying, hey, we got to fill this out to reflect whatever lien you have against your house. Paragraph 3, seller warranty. Loan is assumable. Seller warrants that the assumed loan is assumable provided that buyer complies with and agrees to abide by any requirements, condition imposed by the holder of the assumed loan. So you would check that box if that's true. I'm telling you, there's probably almost none that you would ever check that box because loans are not assumable. Now, could there be exceptions? Absolutely. Smaller banks, they don't mind making assumable loans, but any loan that is sold in the secondary market cannot have assumability. Buyer review period. This agreement is conditioned upon buyer's review of the assumed loan unless buyer gives written notice to seller of buyer's disapproval of the assumed loan within blank days. Mutual acceptance of this contingency shall be deemed satisfied. Seller review period. Seller understands that when loan is assumed, seller may remain liable to pay the holder of the assumed loan if the buyer fails to do so. This agreement is conditioned upon seller's review of the terms of the assumed loan. Unless seller gives written notice to buyer of seller's disapproval of the terms of the assumed loan within 5 days of mutual acceptance, the contingency shall be deemed satisfied. So if the buyer is to assume the loan, then both buyer and seller need to have the opportunity to look at the terms of the assumption. Because in my example, B of A is going to say yes to the assumption, and they're going to put terms out. And they're going to put out terms that protect them. So they're going to probably say, yes, Doris is approved, but if Doris doesn't pay, we're coming back after Ed. And I need to read that and decide if I'm comfortable with that. Right? Does that all make sense? Can be a bit confusing. It also is probably never going to come up. All right? Other terms. Payments to a collection account. This is the very first term in the other terms section because of this assumability thing. If you do a wrap rather than a formal assumption, let's say Doris buys my house and we do a wrap around my B of A mortgage, right? And then Doris pays B of A directly. What's B of A going to notice? Hey, this payment didn't come from Ed Lane. Who the heck is Doris Yuan? Right? When they notice that, they can call the loan due because of the due on sale clause, right? So what people do instead is we reach the same agreement and we set up a contract account. Doris makes a payment into the contract account, and then the contract account pays the mortgage. So it's like a third party, right? B of A is going to see ASI contract collections on the checks. They're not going to be as suspect. They might call me and say, why is that coming from there? Oh, I travel a lot. I just have someone handling my books for me, right? But if that's true, then you're going to spell out who's doing it, right? ASI contract collections or whoever it is. If I can type and spell. Right? To be established and paid for by buyer and seller equally, or to be established and paid for as follows. Most commonly, they just split it, right? Because it benefits both the buyer and the seller to set this up. So typically they will split the costs. And the costs are like $25 to set up the account and then $4 a month to process the payment. So we each covered $2 each. All right. Closing agent may or may not collect collection account setup fees and annual escrow fees at closing. You would check this once you knew what it was going to cost. And typically it's not free. And yeah, you want escrow to collect it, so they set it up. Make sense? Escrow. The collection account shall also serve as escrow for requests for reconveyance or fulfillment deed as applicable, which shall be fully executed by seller at closing and held by the collection account pending payment. This would apply if, in our example, Doris is going to have a contract that lasts long enough to pay the mortgage off in full. But in most cases, this doesn't apply because we're just doing a 2 or a 3 or a 5-year contract. And most mortgages are 30 years, even if they've been open for a while. Taxes, insurance. Are those going to be included? And if so, how are they going to be paid? Right? Seller review of buyer's finances contingency. This agreement is conditioned upon seller's review and approval in seller's sole discretion of buyer's credit report and score, buyer's income tax returns prior to 2016, right? Oh, for the prior, 3 years. Verification of buyer's employment and other, right? You might have divorce decree, previous bankruptcy, things like that. You would want to review those documents. Buyer will provide seller all applicable information, including a credit report and score, if applicable, within 5 days of mutual acceptance, unless seller gives written notice to buyer of seller's disapproval of the applicable conditions within 2 days of the date the information is due. This contingency shall be deemed satisfied. So I basically get to act as an underwriter in this example of Doris and decide, is she a good bet? If I'm going to lend her money, which is in essence what I'm doing, right? Title insurance. Buyers shall pay the cost of lender's standard title insurance policy ensuring seller's security interest and shall pay for the extended lender's title insurance policy if the cost of such extended policy does not exceed the cost of a standard policy by more than 10%. In our example, should Doris get title insurance? No? Oh, heck yeah. Very much so, right? Because what's Doris's risk? Remember, I'm selling my house to Doris on a contract. what should she be worried about?
Title continuation.
Marketable title.
Right. And what do I have encumbering it? Like, I can put in this contract all I want that I owe B of A 400 grand. What if I have a second and a third mortgage that I didn't disclose? Right. So she wants to see the title report and also have title insurance in case there's some lien or cloud that didn't show up in the prelim and then all of a sudden showed up, because that's what title insurance will help cover. So it's extremely wise to make sure that you review all that stuff and understand it and know what you're getting into, because you're aligning yourself with that seller, and you better know what their circumstance is, just like they want to know what yours is. Does that make sense? So just quickly recap, right? This form is very powerful because it's so thorough. It's also not going to be used very often because it's only when you're entertaining a seller carrying the paper, right? But if you do, general terms really spells out how you make sure that you comply with the state and federal laws about being a lender. And then you make a pivot. You decide, am I going to do promissory note and deed, or am I going to do real estate contract? And what's the deciding factor? What instances would you do real estate contract on?
Farms.
That's right. Right? So real estate contract, very uncommon that you would do that. Think of how often you sell a house as compared to selling a farm. Now, layer on top of that, how often do you do a deal where the seller carries a paper, right? So it's most commonly going to be promissory note and deed of trust. It is the most secure, and it's safest, really, for all parties. Any questions? And Linda, I know you jumped in late, but I'm recording it, so you'll be able to watch the beginning and see it. But are there any questions before I stop the recording?
I have one after you stop the recording.
All right, well, let me stop the recording.